All right. Now, what I did is that I've completed the basic and really the basic that you need to know, meaning that once you know all this basic, you can slowly explore into futures trading. All right, so let's talk about specifically the SiMSCI, okay, which is the SGX MSCI Singapore Index Futures. Okay, now the product code for SiMSCI is SGP. However, when we are trading, we don't really call SGP. Okay, we always like to say, hey, look, let's trade the SiMSCI index. Okay, let's trade the SiMSCI. Okay, now SiMSCI index, which is the MSCI index, right, Singapore index, currently maintains a high correlation of 98% to the STI index. STI, we call that the cash index. Okay, so the SiMSCI by itself, the index, has a high correlation to STI. The STI is made up of 22 stocks. Okay, so on the right hand side, what you have here would be the list of STI. Okay, STI component stocks. However, those that's highlighted in yellow, they are component stocks of the SiMSCI. Okay, SiMSCI index, meaning that not all STI component are included into the SiMSCI index. Okay, so that's number one. Number two, however, there's one particular stock that's in the SiMSCI, but that's not in the STI, and that's Suntec REIT. Okay, Suntec REIT is in the STI reserve list. Okay, so you can see, for example, those that's not shaded, they are not included in the SiMSCI index as of July 30th. Okay. All right, now let's talk about the contract specification of the SiMSCI futures. Number one, as you know, we have the product code is SGP. The currency of transaction, that's the Singapore dollar, SGD. The trading hour, well, there's always a joke. Those who are trading the futures have to work harder, okay? Because then it starts trading at 8:30 and earlier, half an hour earlier, and it ends at 5:20, 20 minutes earlier, later. Not only that, okay, we have the T+1, which means that we have nighttime, evening time, nighttime trading. Okay, so well, if you look at it around the clock, right, it's almost that you don't need to sleep. Okay, now the benefit would be, number one, the SiMSCI will be more liquid during where the cash index is open. Okay, so that's a fact. Number two is that if you are able to trade into, for example, the off cash index hours, if anything that happens during the US zone or into the late hours of the European zone, then at least you can do something with the SiMSCI. Okay, so for example, if the US had a sudden huge plunge, all right, then you can immediately be trading into the SiMSCI instead of waiting for the next day for the cash to open and for the gap to happen. Okay, so that's the benefit. Now, number two is that because when you're trading the futures, you're trading half an hour earlier, right? So thus, you will be able to have a sense of the fight, and as well as you can position your trades. Okay, depends on the objective as well, but you can be positioning your trade much earlier before the cash. Okay. All right, the contract listing, we have 2 0-month and 4 quarterly months. Contract multiplier 100. Therefore, the contract size 100 times the futures price and the minimum fluctuation, which is tick by tick, right? And that's 0.05. And if you were to trade one contract, that would be $5. Okay. Well, last trading day, I talk about that. Settlement, cash settlement, final settlement price, that's mark to market. Daily price limit, that's where you have limit up, limit down, and negotiated large trade and position limit accountability. That's not very important. So basically, we covered and you understood, all right, hopefully you understood all the terminology with futures trading. It's not that tough, okay? Now, if you take a look at the correlation of banks, right, the 3 banks with the SiMSCI, then based on the data and the tape and the chart that I have here, then we're gonna see we do see quite a nice correlation of 95%. So, for example, if you decided that you have in your holdings, right, that you have a lot of banks, okay, basically you are holding the 3 banks, or in fact that you also have some of the REITs and then Singtel, all right, and you like to hedge into your position, right, then you can use the SiMSCI because of the high correlation. Okay, now so therefore, if you decided and you like to get to know more about futures trading, especially into the SiMSCI futures, then few things that can be done. Number one, there will be many courses to roll out, in fact, from your clearing agent, so you can attend those courses. And of course that you need to get an account with the futures clearing house as well. And of course that you need to be qualified. That means that you need to attend some lesson or declare your qualification, and that's really easy. So I have Ethan here that will be talking about that later, to share more about that with you. And of course that if you are taking trading the SiMSCI, the margin requirement, all right, to trade one contract would be from the SGX, right, that the initial margin will be 2,200. However, some clearing house, okay, they are asking for slightly more, just to make sure that you don't easily get into the margin call. So some of them are asking for slightly higher, like 2,420 as the date that I was doing my slide. Okay, and the maintenance margin from SGX will be 2,000, and then the maintenance margin from clearing house will also be the same as the initial margin. Okay, so as I mentioned, all right, the clearing agent will always ask for slightly higher than what the exchange asks for. Okay, now later on I'll be talking about some of the method that you can use, okay, and also to introduce a charting platform so we can get the live streaming charts, right, free ones for the futures contract, all right, the SiMSCI. That free platform, you can slide a chart, right, you can also get it from your broker platform as well. Okay, now should you be interested with the single stock futures, then you can consider the newly launched single stock futures, and these will be the 10 stocks that have the futures, and you can trade that. However, right, it is currently available for professional traders. Not to worry, if you can start to trade the SiMSCI first. Okay, so once you gain experience, you can declare yourself as a professional traders, and you can start to trade all these single stock futures contract. Okay, now let's talk about if you have, for example, an existing portfolio of stocks, right, and how do you hedge it. Okay, so for example, let's look at this arrow here. Imagine that when priced in March, okay, it came down so much and you got in at a real low level, okay, and you bought in quite a fair bit of bank stocks, all right. You decided to hold it for long term because then you think that you got it at a very nice price, and you don't want to get in and out. However, when price moves from 2002 2003 level, it moved all the way to 2008, you realize that there's some resistant level here, meaning that previously price was around this level 2008, and right now it offer a resistance. Okay, you are contemplating whether you should be selling your entire bank's holding. Okay, now if you sell it, then what happened? Very soon they're going to give up dividends. All right, and you say, hey, look, I've held all these stocks for so long and finally going to give dividends, and then but it looks like it's going to fall. All right, so what should I do? Should I sell and give up the dividends? All right, but I knew that this is going to be a resistant level, this is going to fall, because then 2008 is a very strong level. All right, I need to do something. All right, you don't want to let it drop. Okay, so what can you do? You can use the futures contract to hedge your existing stock portfolio by selling the futures contract here, by selling the SiMSCI. Okay, now then the question will always be, how many contracts do you want to sell? Okay, so then we will need to calculate the contract notional value. So for example, we assume that at that point of time the SiMSCI futures is trading at 295. Okay, now the multiplier will be 100, thus the value, the contract value of the SiMSCI futures will be 29,500. So that's the notional value that would be for one SiMSCI futures. Okay, now assuming you have 120,000 of Singapore stocks exposed, and they are mainly STI component stocks, okay, mainly banks, and they have a high correlation with the STI index, okay, the cash index. All right. So what you can do is that you can use this particular ratio to calculate how many contracts you can open to hedge your existing stock portfolio. All right. Take the amount at risk, which is 120,000, divide by the notional value. All right. And you're going to get a number, and that number would be the number of contracts that you need to open. Okay, so I have 4.06, so easily we open 4 contracts to hedge your existing stock portfolio. All right. Perhaps you're gonna ask me, hey, look, 4.06 is so easy. What if I end up with 4.6? Then should I trade 5 or should I trade 4? Again, it's really depending on your objective. Okay, some would want to go a little bit under hedge. Okay, meaning that they don't want to hedge their portfolio fully, partly because that if they got it wrong, then maybe both sides might be at risk. Okay, so some people don't want to go full hedge. All right, they want to go under hedge, and if this is the case, then you can open 4. All right, but some would also want to profit from that particular movement, meaning that, for example, they can also make extra money, okay, since that your current basket hopefully can have a good correlation with the Simski, so they go for 5 contracts, which means they went slightly higher. Again, it really depends on your choice. Okay, for me, I'm a little bit more conservative, and my portfolio might not be a total correlation, so I usually tend to under hedge a little bit.